The name of the game is to focus on specific businesses and focus on businesses that you understand without trying to figure out what the market might do in the next month or the next quarter or the next year. So just the way I look at the indices and the markets is really, it's an irrelevant data point.
Don't forget to like and subscribe if you haven't done it already.
So let me ask you, Guy. I read somewhere that you did mention that the idea right now is to try and, or at least a year ago, was to try and figure out how to buy those businesses which will go up 2x, 3x, 4x over the course of the next 3-4 years.
I learned that from Mohnish.
Yeah. So, no, my question is, at the current market juncture across the world, you guys invest across, are you guys looking for 3x, 4x ideas right now? Or are you assigning more weightage to margin of safety, looking at the current market scenario?
Niraj, I sent Mohnish an idea recently. I had a conference in Switzerland and I sent him an idea. And he said, and then you can ask Mohnish what he said. He said, if it's not a 3 or a 4x, I'm not interested.
No, I told him if it's not a 5x, don't waste my time. The conference is called Value X. Yeah. I told him to rename it Value 5X.
5x.
And there's an old Miller beer commercial. It tastes great and it's less filling. One of the things about investing is there is such a thing as a free lunch. So if you find companies that may go up 3 times or 5 times or 10 times, what probably is also the case is they are trading really cheap.
Right.
And so they have a high margin of safety.
Of course.
So a high margin of safety comes with high returns.
Right.
So we are not in a business where it's high risk, high return. If you follow value investing, this is a business which should be low risk and high return.
Okay.
And so there are 100,000 stocks around the world. Our job is to sit on our ass and do nothing for long periods of time. And every so often, there's something that's an anomaly or it's mispriced or people can't see it.
Right.
And that's when you step up and hit the ball for a 6. Recently I was talking to Charlie Munger, and he said that he had been a reader of Barron's, investment magazine for 50 years. And in 50 years of reading Barron's, after 50 years, he made one investment that he found in Barron's. So that's 2,600 issues and probably at least 10 stock recommendations in each issue, something like 26,000 stock recommendations. So he let 25,999 go for 5 decades.
Wow.
And then what he did was he put a small portion, I think he found an anomaly, and put about 10 million or so into this auto parts company in 2001, made about 8x on it. So the 10 million became about 80 million in about 3 years. It went up another 3 times after that, but he'd sold. Then he gave the money to Li Lu, who manages some of the Munger money, and Li Lu converted it to about 500 million now. So in 2001, Mr. Munger, who was already a billionaire, takes a small bit of money, about 10 million, and makes this single bet based on 50 years of reading a newspaper. And that in the last 16 years is a 50 to 1. Yeah. 50 to 1, quite amazing. Yes. So now what are the lessons from there? The single most important skill that an investor can bring to bear is extreme patience. Right. So even though I talked about India needing a paint job, you need to be the kind of person who loves to watch paint dry. And so if you are a person who loves to watch paint dry, this is the business for you. Okay. So one needs to be a gentleman of leisure, right, reading all the time, and looking for anomalies. Sure. And the thing is, the anomalies may not show up in 2017 or 2018 or in 2019. But the idea is, if you study 4,000 businesses in India and you spend 5 or 10 years doing that, you've got enough time to do it. There's no time urgency. And then you make 3 or 4 bets. The chances are very high that you're going to end up with more money than you can ever consume. So just a couple of data points. One is that while the US market's at an all-time high, if you just go back maybe 17, 18 years, we're not that far off from the highs in, let's say, 2000 or so. So the annualized returns from then till now are still below long-term market averages. So if you just take a very long-term view, we're not kind of in unusual territory, if you will. But the second thing, probably more importantly, is that investors are better off just ignoring that.
Investors could be better off betting on index funds? I mean, is that?
Yeah, I mean, I think index funds are a great way to go. And in fact, one of the great points Warren makes in his letter is that he said he's been talking about index funds and the benefits of index fund investing for a long time. But he says that the people who are rich and the people who have large amounts of money under management, institutions, endowments, pension funds, he made the point that they feel that they are entitled to superior service because they are at the upper echelons of the amount of assets they bring to bear. And there's a quote, Wall Street is a place where people who travel in Rolls Royces go to take advice from people who arrive in subways. And so the thing is that the rich believe you get what you pay for. And in the investing business, that is not at all true.
Right.
You do not get what you pay for. And the ability for even a pretty smart investor to be able to forecast what an investment manager is likely to do in terms of performance relative to the index over the next 5, 10, or 15 years is not an easy thing to figure out.
Right.
So for almost everyone, the best answer is the Nifty 50 index. Now, what's the basis points? Is it 7 basis points? If you wanted to index the Nifty 50, is it about 7 basis points?
8,
And here's the thing: no salesman who's going to show up at your doorstep going to say, "Please buy the Nifty 50." The only salesman who's going to say that is yours truly. Okay, because I love your viewers. So the best thing that large institutional investors in India can do, mom and pop investors can do, is go into the Nifty 50 and do dollar cost averaging. The important thing is start saving early, always spend less than you earn, and just keep putting something away. And you'll be surprised, in a few decades, you'll be very rich.
And this is something that we're going to take up in a big way in the second half of this interaction as well. Sorry, guys.
But as Mohnish, I heard Mohnish saying something for your viewers, and I want to tell your viewers as well that it sounds easy. It never feels easy in the process. So I look back, I looked at, over the last 20 years, Mohnish is of a more optimistic nature. There's so many times when I've beaten myself up over how I felt about my investments. And then I look back and I say, actually, I didn't do so badly. It's okay. So, they won't necessarily, your viewers won't necessarily feel good doing it. You just need to keep doing it and trust the process.
Okay, fair point.
I just want to give you another analogy, which I think you've used, Mohnish, is that I'm sure that there are you see wildlife programs of the bears on the salmon run. You have the young bears who are chasing around all over the place trying to catch a salmon. And then you have the old bear who just sits on the rock quietly and every now and then just nabs one. That's the one we want to aspire to be.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.